fast, where truth moves faster than a Holstein calf. No waiting on some pretty page. We're charting new ground in the digital age. From genomic codes to roll-wide facts, we cut through the noise, no holding back. Not your daddy's dairy news tonight. We're sparking debates with every insight. The ring's not where the real fight's at. It's in the data, in the channel chat. From pasture to processor to your morning cup, we're raising the stakes. Try and get ahead of herd. Yeah! Where the future's more than just a word. Ahead of herd. Come on! The bullvine's calling, let your voice be heard.
Welcome back to the Bullvine Podcast. This is where we try to, cut through all that dairy industry noise and get you the insights that actually matter for your operation. Today, we are strapping in for a pretty critical look, a real deep dive into a feature piece we published. It's focused on the Dairy Farm Survival Scorecard.
Yeah.
We're analyzing this really provocative idea that financial health, that's actually the last place trouble really shows up.
Yeah, and this piece has definitely been stirring things up a bit, generating some serious, I'd say necessary friction, because this isn't just theory, right? It's a deep look at the operational stuff, the habits, the maintenance schedules, the human side of things that can predict financial collapse months ahead, sometimes even like 18 months before the bank actually calls. We're really focusing on those leading indicators, and that's what every producer needs right now.
Okay, let's unpack this, because the timing, I think, is just critical here. The market right now, it feels, profoundly disconnected. You got production growing, right? But prices are persistently softening. And that just completely defies the historical trends we're, used to seeing. Normally, tighter margins force immediate production discipline. You pull back. But those normal price signals, they just don't seem to be working this time around.
And what's masking that immediate need for discipline?
Well, it's kind of a dangerous cushion on the input cost side. If you look at Chicago futures, corn's trading around, $4.20 a bushel?
Yeah.
Something like that, which is down maybe 4% from last year. So that relative relief on the feed side, it gives a significant financial buffer. Yeah. But it's really a structural weakness in disguise. It allows marginal operations to sort of keep going without addressing the core inefficiencies. That cushion definitely creates a trap. It lets operations run less efficiently, but they feel like the basic math still works, at least, on paper. We had this quote from a producer down in Lancaster County that just sums up the danger perfectly. They said, and this is really crucial for you listening, the math still works if you don't count labor and equipment replacement. Wow. That delay, that lag in realizing the true, full operational cost, that is the structural flaw this scorecard is really designed to expose. You're just delaying the inevitable reckoning.
And delaying that reckoning means you're delaying essential decisions, often painful ones. And that's not just a financial mistake, it's a psychological one too. We're definitely going to get into the data showing how these psychological factors are actually amplifying market volatility by something like 15, maybe even 25% beyond just pure economics. Ignoring those basic measurable operational standards, it's not just poor management, it's the real measurable early warning sign that comes way before the financial stress hits hard.
Right. And here's where we really need to move past the conventional wisdom. The core issue we identified is that financial trouble, it's almost always a follower. It's not a leader. When your debt ratios start looking bad or, a cash flow gets tight, the actual root cause, maybe the lack of maintenance, the slipping cow care, that chronic decision fatigue that's been going on, silently compounding for months already.
That's the absolute key, the balance sheet. It just reflects the results of decisions you made 6 months ago, maybe longer. But what's really fascinating here, and maybe a bit scary, is that the problems are being hidden even more by these unusual external market forces right now.
Exactly. Okay, let's look at the two big structural factors masking this current operational weakness. Factor number one, China's long-term policy restructuring. And this isn't just a temporary trade tiff, right? Our sources are indicating this is systemic, a multi-year shift towards dairy self-sufficiency over there. That means permanent reductions in the import volumes they used to take. So all that global product that used to flow easily to Asia, it now needs to find new homes. And that keeps this sort of perpetual lid on global prices. That's a structural change, folks, not just a cyclical dip.
And then the second factor is domestic. It's the explosion of new cheese processing capacity right here in the U.S. These huge plants, built with massive capital investment, they need constant throughput just to justify their debt load. So what do? They actively compete for milk supply. Sometimes they offer incentives even when the actual end market consumer demand for cheese or whatever is soft or just flat.
Which creates this, well, artificial demand signal. It tells you, the farmer, keep producing. Maybe even push for higher volumes, when every fundamental signal outside of that processor's immediate need should probably be saying, hey, tighten the belt.
And that's the danger on the ground. If your higher milk check isn't coming from genuine consumer market strength, people buying more yogurt or cheese at the store, but it's being propped up by a brand new processor who just needs to hit, say, 85% capacity to pay off their construction loan. Well, what happens the moment they hit that minimum throughput? Or what if the general market finally catches up to reality, the bottom just drops out, and the farms that didn't adjust their operations didn't get efficient? They're going to feel that sudden severe pinch because they haven't been running lean.
Okay, now let's pivot to the human element, because this operational slide we're talking about, it's so intimately tied to farmer stress. And the data here is, frankly, it's alarming. When you are under chronic stress, the quality of your decision-making changes dramatically.
Oh, absolutely. It permeates every single decision you make, from, whether you invest in the right genetics all the way down to how closely you monitor your fresh cow protocols. When you're running on fumes day after day, you inevitably make expensive mistakes, often ones you wouldn't normally make.
Let's just try and contextualize the pressure you might be facing. Our sources, they cite NIOSH data showing dairy farmers experience depression at rates around 35%. 35. That's nearly double the, 17-18% in the general population. Anxiety disorders, they affect 55% of farmers versus maybe 18% broadly. And when the American Farm Bureau finds 76% of producers reporting moderate to high stress, well, you're dealing with a population under severe, sustained pressure, both operationally and psychologically.
And this is exactly where we connect the dots back to the market volatility. This immense pressure leads directly to what you could call non-rational economic behavior. This is kind of the contrarian analysis part. The systemic stress is actually what amplifies market volatility by that 15 to 25% we mentioned. It's not just simple supply and demand anymore. It's emotion driving commodity pricing swings.
But how does that work? How does farmer stress translate into measurable market chaos? We see these clear behavioral patterns emerge, like producers are anchoring their expectations. They're stuck on those favorable price levels from a couple of years back, which makes it psychologically almost impossible for the market to find a new, lower equilibrium. It just delays necessary adjustments like culling or maybe consolidation. They also start avoiding major decisions, which again, just delays needed adjustments. And crucially, there's the identity factor. Downsizing can feel like admitting personal failure, right? Which can lead to really poor hedging decisions or sudden unexpected liquidation events that then flood the market.
Okay, let me try and put that in plain English for the farmer listening right now. This explains those synchronized regional patterns you see sometimes, like culling waves or sudden expansion pushes that honestly make no individual sense sometimes. If your neighbor is really financially distressed and suddenly they start aggressive culling just because the beef price ticked up, that panic can ripple outwards. It really can. Suddenly, the whole neighborhood seems to follow suit, regardless of their own individual herd dynamics or whether their cull rate was actually fine to begin with. You end up making decisions based on your neighbor's emotional exhaustion, not your own farm's balance sheet or a carefully considered market outlook. That collective emotional reaction, that's the 15-25% extra volatility we're seeing.
That synchronized behavior, that's the perfect signal that we really need to look internally first. So let's move into those operational warning signs. The subtle things, the insidious slide that shows up months before the balance sheet finally reflects the trouble.
Right. Because, look, you can kind of massage a balance sheet for a while, maybe with credit lines or just delaying paying bills for a quarter or two. But the cows, the facilities, the equipment, they don't lie. They tell you the true state of the business.
So what are the first casualties usually? It often starts with maintenance. We heard from a consultant covering Michigan down through Kentucky who noticed this consistent pattern. Producers start delaying routine preventative maintenance. It's things like putting off replacing that critical bearing in the mixer wagon.
Right.
Or, opting for just a temporary Band-Aid fix on a skid steer hydraulic line instead of doing the proper scheduled repair.
Yeah, and we need to be really clear here. This isn't just about, morale or keeping things tidy. This is about compounding cost. Deferred maintenance is financially expensive, period. You're trading a small, scheduled, controlled cost today, maybe that $500 bearing, and 2 hours of planned downtime for a massive, uncontrolled emergency repair bill tomorrow. You know, the $5,000 tow bill plus 6 hours of downtime that always happens at 2 a.m., right when you're already short on sleep. The successful operations, they maintain those preventive maintenance schedules almost religiously, regardless of the current financial pressure. They see it as capital preservation, not just a cost to be cut.
We see the decline just as clearly in animal care, too. Skipping the scheduled semi-annual hoof trimming, maybe delaying the vet visit for the routine bred cow checks. And the decline in facility cleanliness is often a really key visual sign, especially in those less visible areas, like the dry cow pens. That critical transition phase for cows needs laser focus. But when stress hits, the dry cow area is often the first place where operational standards start to slip, mainly because those cows aren't producing immediate revenue right then.
That's the absolute truth. And it's just biology, isn't it? Not just opinion. The dry cow, she's the foundation for the entire next lactation. Ignoring her health is basically a guaranteed financial hit 6 weeks down the line when you're suddenly dealing with expensive fresh cow problems, which then translates into massive reproductive costs, early culling. It's a cascade.
I love that anecdote you mentioned from the Dodge County producer who said something like, when we stopped doing our weekly walkthroughs, the ones that only took 20 minutes just to look for clutter or leaks, that's when everything else started falling behind. That simple attention to detail, that's often the first casualty of chronic decision fatigue.
Okay, so now let's move into the core solution identified in our analysis, the 8-point assessment framework. This framework is specifically designed to target and score that operational stress, that vulnerability, like 6 to 18 months before the financial trouble really surfaces. Yeah, this is really the heart of the analysis, and the data supporting it is, well, it's pretty staggering. Operations that consistently maintain 32 points or more on the scorecard out of a possible 40, they show the 95% survival rate over 5 years. Compare that to only 35% survival for those scoring below 16 points. 95% survival. That's not just a slight edge, that's almost a guarantee of resilience, isn't it? It clearly demonstrates that your management habits, your operational discipline, are the ultimate predictor of business longevity.
We absolutely need to spend some real time on this framework. So let's break down all 8 indicators. Let's focus on the specific behaviors that put you at a score 1, which is severe distress, versus a score 5, which is thriving resilience.
Okay, let's start with indicator number 1, decision consultation patterns.
Right. So when stress rises, the default for many producers is, unfortunately, isolation. If you score a 1 here, you're basically making most major strategic decisions entirely alone. Things like big equipment purchases, major genetic changes, strategic feeding alterations. You do it alone because collaboration feels slow, maybe exposing vulnerabilities feels risky. It's often fueled by a mix of ego and just pure exhaustion.
Conversely, the operation scoring a 5 here, they consistently seek out and actually integrate external input. They might have scheduled formal advisory board meetings. They probably utilize a farm financial consultant regularly, and they ensure that major capital decisions are thoroughly debated with family members and advisors before pulling the trigger. This collaborative approach, especially under stress, produces measurably better, more objective outcomes. It helps take some of that internal stress out of the equation.
Okay, indicator number 2. Technology utilization. This one really surprised us, actually, because it's not about the initial cost of the tech. It's about the failure to use the tools you already own effectively.
Precisely. The struggling operation that's a score 1, they often use less than half of the available features in their sophisticated systems. They might have, say, robotic milking systems or advanced fresh cow monitoring tech, but they only glance at the total pounds of milk shipped. They're ignoring the rumination data that could predict acidosis 3 days in advance, or maybe they fail to set up alerts for sudden drops in parlor throughput that could signal a labor issue or a procedural breakdown. They paid for all that data, but the psychological overwhelm just prevents them from actually using it effectively.
Whereas the score 5 operation, they're actively leveraging those tools. We integrate the data daily, maybe even hourly, to preemptively solve problems before they become big and costly. They view their tech system not just as an expensive machine, but as a strategic labor replacement for monitoring and early detection.
All right, moving to indicator number 3, risk management engagement. This one feels counterintuitive because financially pressured operations often abandon these tools first.
Yeah, they start seeing the premiums for crop insurance, or for government programs like LRP livestock risk protection or DMC dairy margin coverage. They see those as unnecessary expenses, especially when cash flow is really tight. If you basically cut all your hedging or insurance programs entirely, you score a 1.
Right. When you arguably need that protection the most, you cut it to save cash today.
But the survivors, the score 5s, they maintain a layered risk management strategy. They view insurance and hedging as a critical protection, really a fixed cost of doing business, not just an expense line item to be slashed. They might use a combination of futures contracts, LRP, DMC, maybe forward contracts to protect against margin volatility, even if it feels expensive in the short term. They understand deep down that a single catastrophic event, a Direcco, a sudden market plunge, can wipe out 5 years' worth of premium savings in an instant. Okay, indicator number 4 relates directly back to that stress we were talking about earlier. Work-life balance, personal health.
Consistent 70-plus hour work weeks year after year after year. That's a clear score 1. That level of chronic overwork inevitably leads to massive decision fatigue. And that fatigue is directly correlated with expensive operational mistakes, health issues, you name it. It is simply not sustainable or strategic in the long run, no matter how much you might love farming. And we see it in the data. The deterioration of physical and mental health often precedes the big operational problems by months. It's another leading indicator.
The producer scoring a 5 here, they consistently work maybe 50 to 60 hours, and they aggressively guard non-negotiable family time. They view sufficient sleep, mental clarity, maybe even exercise, as critical operational assets, not luxuries. They understand that running yourself into the ground only makes the business more vulnerable to poor decision-making when the next inevitable market shock hits.
Okay, now for the final 4 indicators. These often get ignored until it's really, really late in the game. Indicator number 5, preventative maintenance standards.
A score 1 here basically means you're living in perpetual crisis mode. You run machinery until it breaks down, period. Your maintenance is entirely reactive, not proactive. Examples. Maybe your bulk tank generator hasn't been tested since the last power outage 6 months ago. Or you only bother to grease the parlor chain when it starts squealing violently during milking.
The Score 5 operation, though, they have detailed written maintenance schedules. Maybe it's a whiteboard in the shop with required hours and dates listed for critical assets like the parlor vacuum pump, the feed mixer gearbox, the cooling systems. They actually budget time and resources every month for preventive work because they know deep down that scheduled downtime is always less expensive and less disruptive than an emergency failure.
Indicator number 6, facility and equipment care. This is more about the visual signposts of operational discipline, what things look like.
Yeah, a Score 1 is visible clutter everywhere, potential safety hazards lying around, excessive trash, just general neglect, especially in storage areas or maybe along the perimeter fences. Equipment sits broken for weeks waiting for a part or repair. The lanes, the holding area, the facility itself are often just messy. This signals mental fatigue, doesn't it? The producer is likely too overwhelmed to manage the physical environment properly.
The Score 5 operation, by contrast, maintains their facilities and equipment pretty much to a visitor-ready standard most of the time. Tools are put away after use, facilities are generally clean, and the whole environment promotes efficiency and safety. This attention to detail reflects a management mindset that really prioritizes order and control, even within what can be a pretty chaotic environment.
Okay, indicator number 7, family time protection. This one is very specific and often overlooked in business assessments.
A Score 1 here means family meals are either non-existent or they're constantly interrupted by farm crises, big or small. Weekends, holidays. They're consistently sacrificed for routine tasks that maybe could have been planned differently or delegated. Yeah. The farm has essentially bled into every single aspect of personal life, which fuels resentment and burnout, not just for the primary operator, but for the whole family unit.
A Score 5 operation, they have established non-negotiable family time. They make it a priority. They might strategically automate certain tasks on Sundays, or maybe they hire part-time relief labor specifically to guarantee that family time is protected. They understand fundamentally that family unity and support is actually a critical business asset, especially during stressful times.
And finally, indicator number 8, personal health prioritization.
This really gets down to the individual physical component. A Score 1 producer tends to ignore chronic symptoms, that nagging back pain, the persistent heartburn. They skip mandatory medical checkups. They rely on minimal sleep and often poor nutrition just to get through the day. They might even see taking time off for their own health as some kind of moral failure or weakness.
The Score 5 producer, though, they actively prioritize their health. They schedule those regular checkups and actually go. They integrate mandatory rest periods into their week. They might engage in stress management activities, whether it's regular exercise or just deliberately taking time away from the farm. They recognize that their own physical and mental health is basically the engine of the entire business, and like any critical engine, it must be maintained to function properly.
So the bottom line here is, if you, the listener, are maybe scoring yourself and you come out below 24 points total on this framework, you really need to focus immediate energy on fixing those foundational operational flaws. Because the financial trouble isn't just coming, it's likely already been built right into your system through these habits.
Okay, let's talk about regional patterns now, because this score, this vulnerability, it doesn't necessarily apply everywhere at the exact same time, does it? And this variation actually creates some unique opportunities, both for profit and just for strategic positioning.
It absolutely does. Our sources highlighted that the upper Midwest, places like Wisconsin, Minnesota, they seem to be experiencing this kind of operational stress a bit earlier. Why? Well, often it's due to higher regulatory pressures, particularly on environmental compliance. Plus, they frequently have older facilities that just naturally require higher maintenance costs and more capital investment just to keep functioning efficiently.
Meanwhile, you look at southern or western farms, maybe Texas, Georgia, North Carolina, parts of the West, they might hit their operational breaking points 6, maybe even 12 months later. This is often because they benefit from newer, generally more efficient infrastructure. Or maybe they've adapted particularly well to specific seasonal management systems, which allows them to postpone certain capital expenditures for a bit longer. You can potentially use these regional stress indicators to help time market moves, maybe if you're in a position to expand. Or, unfortunately, if you recognize you might need to plan an exit strategy.
And this leads us right into the discussion about scale. Because scale definitely matters, but maybe not in the way that conventional wisdom always suggests. Smaller operations, let's say around 150 cows, they definitely face higher fixed costs per unit of milk produced. No doubt about it. That makes margin compression especially challenging for them. However, they also tend to have significantly more operational flexibility. Think about it. It's much easier and faster to implement and adjust, say, your transition cow protocols on 150 cows than it is to change standard operating procedures across a 2,000 cow dairy with multiple shifts and teams.
Yeah, that's a great point. And on the flip side, those larger operations at 2,000 cow dairies, they amplify every single inefficiency. If your dry cow management system is just a little bit sloppy, well, 2,000 cows worth of sloppy is exponentially more financially destructive and, frankly, much harder to correct than 150 cows worth of sloppy. They require absolutely superior organizational discipline just to break even sometimes, let alone thrive.
So the contrarian point here, and this is really crucial, is that success is actually seen at every scale reflected in the data we looked at. You see absolutely thriving 200-cow operations because they emphasize tight management and they consistently score high on that 8-point operational framework. And unfortunately, you also see struggling 2,000-cow operations that simply haven't conquered their organizational inefficiencies or that underlying decision fatigue. So discipline, proactive management, those are the true differentiators, not just size alone.
Okay, let's wrap this up with maybe the final most powerful predictors we found. These are things that sort of stand outside the 8-point framework itself, but they strongly confirm the vulnerability. And the strongest overall predictor we identified was family dynamics.
Yeah, this is often the quiet red flag that advisors, maybe even lenders, can easily miss. When family members start taking off farm jobs, especially after they were previously working full-time on the operation, that is a massive immediate indicator. It signals that the financial stress has likely translated into an internal breakdown of the family's reliance on the farm, forcing a fundamental change in the labor model and income sources.
And the data really supports the importance of this relationship factor. It's stark. When off-farm income exceeds 50% of the total household earnings, or when family members actively start avoiding farm financial discussions and refusing to look at the books or the bank statements, the probability of business failure jumps dramatically, up to 65%.
But then look at the other side of that coin. Strong family unity, shared decision-making, real communication during those tough times. That correlates with a staggering 92% operational survival rate over the long term. That number just tells you almost everything you need to know, doesn't it?
Yeah.
You really have to accept that the psychological health, the operational health, determines the financial health, not the other way around.
It really all comes down to adopting that proactive mindset, learning to separate what you can control from the chaos you can't. That Vermont producer we quoted earlier, they articulated it perfectly. They said something like, "We decided early on that we couldn't control milk prices or regulations, but we could absolutely control how we manage stress and how we made decisions together." That perspective, that's what allows you to score a 5 on that operational framework, even when the external market pressures feel like a 10 out of 10.
Exactly. That ability to differentiate between what you can influence and what you just have to weather, that's true management maturity. And ultimately, that's what saves operations.
All right, let's try and bring it home now. Our listener, maybe they just finished morning milking, they're driving to the feed store right now, thinking about this scorecard. Based on everything we've covered, what are the 3 most essential actions they need to think about implementing, starting now?
Okay, let's start with the immediate action this week. The preventative maintenance audit.
So, action 1. Immediately pull up and review your preventive maintenance standards. That was indicator 5 in the framework. Make sure that scheduled critical work actually gets done this week, even if it means a little bit of planned short downtime. The data is just crystal clear. Preventive maintenance is consistently cheaper than emergency repairs down the road.
And a practical tip to go with that. Reinstitute those simple, maybe 20-minute weekly walkthroughs. Focus just on facility cleanliness, looking for hazards, checking organizational discipline. Pay special attention to the dry cow area and those critical facility transition zones. Honestly, it's the cheapest early warning system you possibly have.
You're right. Next up, let's look at the medium-term strategy. Next 3 to 6 months. The scorecard checkup.
Right. Action 2. You've got to take the time for an honest self-assessment. Score your operation using the full 8-point framework we discussed. And be tough, be honest. If you find yourself scoring below, say, 24 points total, you need to focus immediate energy on improving the lowest scoring areas first. Especially look at decision consultation, that's indicator 1, and technology utilization, indicator 2, because those often signal that internal overwhelm is a key issue.
And the practical tip here is really about efficiency with what you already have. Commit to fully utilizing your existing technology. Dive into your robotic data, actually use your fresh cow monitors, explore all the features of your management software before you even think about spending a single dime investing in something new. Chances are there's a lot of value just sitting there in your office waiting to be extracted.
Good point. And finally, let's talk long-term positioning, next 1 to 2 years.
Building resilience. Okay, action 3. Maintain multiple risk management tools. Keep that LRP and DMC coverage active. Maintain sensible futures or forward contracting positions. Do it even when the premiums feel tight or uncomfortable. The data proves that this layered protection is absolutely essential when market volatility and likely your own stress level is highest.
And the long game tip here is really about securing your foundation, both the material side and the human side. Yeah, lock in feed and input supplies when you see favorable terms, absolutely. But maybe most critically, prioritize your personal health and find sustainable work patterns. Aggressively guard that family time, because preventing decision fatigue in yourself and your team, that is probably the most strategic long-term move you can possibly make for the health of the business.
Well, this has been another, I think, really critical analysis into what matters most on the farm today, which is really your operational and your mental resilience, because that ultimately drives your financial outcomes.
Yeah, this has been another deep dive from the Bullvine podcast. If this kind of no-nonsense analysis helps your operation, definitely head over to www.thebullvine.com. There are plenty more articles there that really tell you what's actually happening in the dairy industry.
And seriously, subscribe wherever you get your podcasts. We're releasing these deep dives twice weekly now, covering a lot of ground. And trust me, you really don't want to miss what we've got coming next week. We're diving headfirst into that ongoing debate. Is aggressive expansion during downturns the strategically right move for long-term consolidation? Or is radical efficiency and serious debt reduction the only sustainable way forward right now? We're going to break down the data behind both perspectives. See you then.